All right, so are you ready to get into some serious stock market strategy?
Yeah, let's do it.
I figured you would be. We want to uncover those super performance stocks, the
Yeah.
ones with the potential to absolutely skyrocket, right?
Yeah,
We're talking about the kind of stocks that could, well, turn your portfolio into something pretty impressive, right?
absolutely.
You shared Mark Minervini's Trade Like a Stock Market Wizard. So I think this is going to be a good one.
Yeah, I think so.
Let's see if we can unlock some of his secrets and figure out how to find those elusive stocks.
Um, Minervini's approach is really fascinating. Um, he goes way beyond just the usual investing advice. He focuses specifically on finding those stocks that have the potential for like massive growth. So this isn't about just picking up a few extra percentage points here and there. This is
Wow.
about identifying those companies that could multiply in value many, many times over.
Yeah, that's what we're here for. Right.
Exactly.
Not just the slow growth stuff.
Yep.
And it's not just theory. I mean, the guy won the US investing championship, so he clearly knows a thing or two about picking winners, right?
Yeah, he definitely does. And he doesn't just tell you like what to do. He actually breaks down the why, like the logic behind his strategies. And he doesn't shy away from like the psychological side of investing either. He talks about the common mistakes that investors make, like chasing after stocks that have already peaked, that classic buy high, sell low trap that's driven by fear and greed, right?
So how do we avoid that? How do we not fall into those traps? Well, he throws out that old buy low, sell high mantra right from the start. I was surprised by that, actually. He says it's not about the price, it's about the value. But what does that even mean in a practical sense?
So think of it this way. A low price doesn't automatically make a stock a bargain. You know a company could be cheap for a reason. Maybe its business is fading. Maybe it's facing some serious headwinds. What we really need to identify is like a mispriced value, like
Yeah.
where the market hasn't yet caught on to a company's true potential.
So how do we do that? How do we spot that potential before everyone else jumps on the bandwagon and bids it up?
Well, one of the key indicators that Minervini focuses on is earnings growth,
Mm.
and more specifically, the acceleration of earnings. So he argues that superperformance is often driven by companies whose earnings are growing faster than Wall Street analysts expect.
So it's not just about looking at like a company's past earnings, right?
Yeah,
It's about anticipating where those earnings are headed.
that's right.
Are they on an upward trajectory? Are they consistently beating expectations?
Exactly. And when you see that kind of earnings momentum, it can create a really powerful feedback loop. So strong earnings, they attract investors, that pushes the stock price higher, and then that can attract even more investors, kind of like a snowball effect.
Right.
You know, a great example of this is Home Depot in the 90s. Their earnings just accelerated dramatically, and that drove their stock price up like exponentially.
That sounds like a pretty compelling case for focusing on earnings. But how do we make sure we're not buying into a company that's all hype and no substance?
Yeah, that's where a lot of investors get tripped up. They see a stock that's run up in price, and they just assume it must be a good investment. But Minervini warns against buying into what he calls broken leaders. These are companies that were once high flyers, but they've stumbled. And it might not be immediately obvious why.
So how do we avoid that broken leader trap? What are some red flags we should look out for?
Well, one warning sign is declining margins. If a company's profit margins are shrinking, that could be a sign that they're facing increased competition. Or maybe their costs are rising faster than their revenues. Another red flag is insider selling. If company executives and directors are dumping their shares, it could be a sign that they're not confident in the company's future prospects.
Right. They know something we don't.
Oh,
So those are some things to watch out for. Minervini provides this, I guess you could call it a framework, for understanding where a stock is in its overall growth cycle. He calls it the 4 stages of a stock's life. Could you walk us through those?
Sure. He starts with stage 1, neglect. This is when a stock is relatively unknown. It's trading at a low price, and it's not attracting much attention. It could be a hidden gem or it could be a dud. It's kind of hard to tell at this stage.
Sounds like a little bit of a gamble there. What about stage 2?
Stage 2 is called advancing. This is where things start to get interesting. Earnings growth is picking up, it's starting to attract the attention of investors, and the stock price is starting to climb. This is really the sweet spot. This is the stage where we want to be.
Okay, stage 2. Got it. But how do we identify those stocks that are about to enter this, exciting phase?
Well, that's where Minervini turns to charting.
Yeah.
And this is where things get really interesting. He views charts not just as a way to track price, but as a visual representation of supply and demand. So it's showing how investors are actually behaving.
I'm intrigued.
Yeah.
Tell me more about this, about how we can read these investor tells in the charts.
Okay, so one pattern that Minervini highlights is the volatility contraction pattern, or VCP for short. And this involves looking for price swings to tighten up as a stock consolidates. So it indicates that large investors are quietly accumulating shares. Think of it like a coiled spring, building up energy before it releases.
So we're looking for that moment when the stock is like poised to break out, like a runner getting ready to sprint off the starting line.
Exactly.
What other charting clues can we look for to kind of tip us off?
Minervini also emphasizes the importance of identifying breakouts. So these are the moments when a stock decisively moves above a key resistance level on strong volume. That surge in volume is often a sign that institutional investors are starting to pile in, and they're fueling that upward move.
So we're looking for a combination of factors here: tightening price action, a surge in volume, and a break above resistance. These are all signals that something big might be brewing. And Minervini says one of the most compelling patterns is what he calls the primary base. And this is a pattern specific to newly public companies. He says these primary base breakouts can be the launching pads for some of the biggest stock market winners, like finding a diamond in the rough.
Exactly.
This is exciting. But how do we separate the true gems from the duds in this really early stage?
Well, Minervini suggests looking for companies with strong earnings growth, expanding margins, and innovative products or services that are really disrupting their industries. It's not just about being early. It's about being early to the right companies.
So we're not just evaluating these companies in a vacuum, right? We're also considering the broader industry trends, and we're trying to find those sectors that are poised for growth.
That's right.
And within those industries, are there specific types of companies that we should be kind of prioritizing?
Absolutely. Minervini really emphasizes identifying the true market leaders. So these are the companies that are setting the pace, they're driving innovation, and they're capturing market share.
These are the companies that aren't just riding the wave. They're the ones creating it.
Exactly.
How do we spot these market leaders?
He says that true market leaders often have low correlation with the general market, meaning they can kind of move independently, even zig when the market zags. A great example is Panera Bread during the dot-com crash. So while the Nasdaq was plummeting, Panera was soaring. It just demonstrates the power of a strong business model, even in a really turbulent market.
Powerful example, focusing on the fundamentals.
Exactly.
Regardless of what the overall market is doing.
Exactly. It's about tuning out the noise and focusing on those companies that are truly exceptional. And this idea of market leadership really ties back to those charting concepts we were discussing earlier. These market leaders often reveal their strength through their price and volume behavior.
So these aren't just theoretical chart patterns, they can actually point us to those real-world market leaders.
Exactly. They're like footprints in the sand telling us which way the big investors are moving. Remember the volatility contraction pattern, the VCP? You often see market leaders forming those tight, coiled bases before they break out to new highs.
And those breakouts, they're often accompanied by a surge in volume,
Right.
which confirms that the big institutions are getting on board.
Yeah.
So we're looking for this confluence of factors, both in the fundamentals and in the chart patterns, to kind of pinpoint those potential super performance stocks.
Exactly. Minervini's approach is really all about piecing together those clues, like a detective solving a case.
Very cool.
And one of the most exciting clues we can find is that primary base pattern, especially when it occurs in a company that's disrupting its industry and showing those classic signs of a market leader.
Makes you want to go back and study all those charts.
Exactly.
This has been incredibly insightful, but let's not forget about arguably the most crucial element of his philosophy: risk management.
Oh, absolutely. He's adamant about protecting your capital. He recognizes that even the most brilliant analysis can't predict a future with 100% certainty.
Right. So how does he suggest we approach risk management in a way that maximizes our potential for these super performance stocks, but also keeps our hard-earned capital safe?
Well, that's what we'll unpack next. Minervini doesn't just offer vague advice. He gives very specific, actionable strategies for managing risk. And they're really crucial for anyone looking to trade like a stock market wizard.
All right, I'm looking forward to it. Let's take a quick break, though, and we'll dive into risk management right after this.
That's good.
Okay, so we've laid some groundwork here. We know earnings growth is crucial, but it's not just about the numbers themselves, right?
That's right.
Minervini really dives into the quality of those earnings.
Exactly. It's like, Looking under the hood of a car, sure, it might look shiny and fast on the outside, but you want to make sure the engine's in top shape too. Minervini's all about looking beyond just the surface.
Makes sense. So what are some of the signs that a company's earnings are, let's say, less than robust?
Okay, well, one red flag is when earnings growth is primarily driven by cost-cutting measures. So that might look good on paper in the short term, but it's not really sustainable. You want to see earnings that are driven by genuine top-line growth, meaning the company is actually selling more of its products or services.
Right. If you're just squeezing profits out by slashing expenses, eventually there's nowhere left to cut, right?
Exactly.
What else should we be watching out for?
Minervini emphasizes the importance of looking at how the stock price reacts to earnings announcements. So a company might report strong earnings, but if the stock sells off afterward, that's a sign that investors aren't really convinced.
It's like the market saying, we see what you're doing, but we're not impressed.
Right, exactly.
So even if the numbers look good on paper, we need to pay attention to how the market is interpreting them.
Absolutely. In fact, he goes as far as to say that the stock price is the ultimate truth teller when it comes to earnings, because it reflects the collective wisdom of the market, taking into account all the information that's available.
Interesting. Okay, so earnings quality is key. But what about the bigger picture, the market environment that these companies operate in?
Well, Minervini highlights the importance of what he calls industry group strength. He points out that it's often easier to find super performance stocks within industries that are already showing strong momentum.
Makes sense. It's like riding a wave. If you're surfing in the right spot, you're going to catch bigger waves
Exactly.
and have a much more enjoyable ride.
Right, you want to be in those industries that are on the rise, that have those tailwinds pushing them forward. He also encourages looking for industry groups that are emerging from a period of neglect, where investors have overlooked them and their valuations are still low.
Interesting. So we're not just evaluating companies in a vacuum, we're also considering the broader industry trends and looking for those sectors that are poised for growth
That's right.
within those strong industries. Are there certain types of companies that we should be, I don't know, prioritizing?
Absolutely. Minervini emphasizes identifying the true market leaders, the companies that are setting the pace, driving innovation, and capturing market share.
These are the companies that are not just riding the wave, they're creating the waves.
Exactly.
So how can we spot these market leaders?
Well, he says true market leaders often have low correlation with the general market, meaning they can kind of move independently. They can even, zig when the market zags. He gives the example of Panera Bread during the dot-com crash. While the NASDAQ was plummeting, Panera was soaring. It just demonstrates the power of a strong business model, even in a really turbulent market.
It's a powerful example of how focusing on those individual company fundamentals can lead to those incredible results regardless of what the overall market is doing.
Precisely. It's about tuning out the noise.
Yeah.
And focusing on those companies that are truly exceptional. And this idea of market leadership actually ties back to those charting concepts we were discussing earlier. These market leaders, they often reveal their strength through their price and volume behavior.
So they're not just theoretical, those chart patterns. They can actually point us in the right direction.
Exactly. Remember that volatility contraction pattern, the VCP. You often see market leaders forming those tight coiled bases before they break out to new highs.
And those breakouts are often accompanied by that surge in volume,
Right.
which is a signal that the institutions are getting on board.
Exactly.
So we're looking for this confluence of factors, both in the fundamentals and in the chart patterns, to kind of help us pinpoint those potential super performance stocks.
Exactly. Minervini's approach is all about piecing together those clues, like a detective solving a case.
I like that analogy.
And one of the most exciting clues we can find is that primary base pattern, especially when it occurs in a company that's disrupting its industry and showing those classic signs of a market leader.
This is great stuff, but let's not forget about what's arguably the most crucial element of Minervini's philosophy: risk management.
Right. He's very clear about that. He's adamant about protecting your capital, recognizing that even the most brilliant analysis can't predict the future with 100% certainty.
That's the truth. So how does he suggest we approach risk management in a way that kind of maximizes our potential for super performance, but also keeps our hard-earned capital safe?
Well, that's what we're going to unpack next. Minervini doesn't just offer some vague advice. He provides very specific, actionable strategies for managing risk. And they're really crucial for anyone looking to trade like a stock market wizard.
Okay, so let's get into risk management. I think this is where a lot of investors could use some guidance.
Yeah, for sure.
It's easy to get caught up in the excitement of finding a potential super performance stock, but we need to remember the downside too.
Absolutely.
Yeah.
Minervini doesn't sugarcoat the risks involved in trading.
Hmm.
He's very upfront about the fact that even the best traders, they're going to experience losses.
Right.
What separates the successful traders from the rest is their ability to manage those losses effectively.
He has this one rule: never let a loss grow larger than your average gain. Can you unpack that a bit?
Sure, think of it this way. If you're consistently letting your losses run, while you're cutting your winners short, you're fighting an uphill battle.
Right.
You're stacking the odds against yourself.
It's like digging yourself into a hole. The deeper you go, the harder it is to climb out.
Exactly.
So how do we avoid that trap?
One tool that Minervini advocates for is what's called a stop-loss order. It's basically a predetermined price at which you'll automatically exit a trade if the stock moves against you. So it takes the emotion out of the equation. It forces you to cut your losses before they get out of hand.
That makes sense. But isn't there a risk that we could get stopped out of a winning trade prematurely? Especially if the stock is volatile.
Yeah, there's always that risk. And that's why placing your stop-loss orders strategically is so crucial. Minervini suggests placing your stop below a key support level on the chart. So you're giving the stock some room to breathe, but you're also protecting yourself from a significant decline.
So it's about finding that sweet spot. A stop loss that's tight enough to protect you from a major loss, but not so tight that it triggers on, just normal price fluctuations. It sounds like mastering this aspect of trading takes practice and experience.
It definitely does. And Minervini also stresses the importance of having a plan for what to do after a stock hits your stop loss. Do you hold on to the cash and wait for another opportunity? Or do you immediately redeploy that capital into a different trade? These are all decisions you should make before you enter a trade, not in the heat of the moment.
Makes sense, having that clear strategy in place so you're not reacting emotionally to these market movements.
Right.
I can see how that would lead to much better decision making.
He compares it to like a seasoned chess player, thinking several moves ahead.
Right.
It's not just about reacting to your opponent, it's about anticipating their next move
Right.
and having a counter strategy ready.
All right, that's a good analogy.
Yeah.
What about protecting our gains? I think that's something a lot of investors struggle with, knowing when to take profits.
Yeah, it's tempting to hold on to a winning stock, hoping it'll keep going up forever, but that's often when things can go wrong.
Right.
Minervini emphasizes the importance of not getting too greedy. He suggests scaling out of a position as it rises, taking some profits off the table, and reducing your risk along the way.
So lock in some of those gains along the way, rather than risking it all on one big bet.
Exactly.
That sounds like a much more prudent approach. What about diversification? That's something we always hear about in traditional investing advice.
Well, Minervini actually challenges the conventional wisdom on diversification, especially for those seeking super performance. He argues that spreading your capital too thin across a large number of stocks, it can dilute your returns.
Right.
He advocates for concentrating your capital on your highest conviction ideas, the stocks that you truly believe have the potential to become those multi-baggers.
It's like having a starting lineup of all-star players, rather than a team full of, mediocre players.
Exactly. You want to focus your resources on those stocks that have the greatest potential for explosive growth. Minervini himself, he typically holds just a handful of stocks at a time, but he meticulously researches each one and manages his risk very carefully.
Well, this deep dive into trade like a stock market wizard has been awesome. We've covered so much ground, from how to spot those super performance stocks to managing our risk with precision.
Yeah, we've learned a lot.
We've talked about how to analyze earnings growth, decode chart patterns, and avoid those psychological pitfalls of trading. But remember, this is just the beginning. The real work starts now.
That's right.
You've got to take these principles and apply them to your own investing journey. Start exploring, keep learning, and always remember to manage your risk. Who knows, you might just uncover the next super performance stock that's waiting to be discovered. Thanks for joining us on this deep dive. We'll be back with more insights from your sources soon.